Hi, I'm Ward Brown, and I'm here today with Scott Harrison, longtime portfolio manager of our Argent Dividend Select Portfolio. So Scott, we have a very different looking market in the first couple months of the year that we've had for the last couple years, where we had unexpectedly strong economic growth, back-to-back 20% years in the market. And this year, things have just been flipped on their head. We have this influx of headlines that seem to change by the minute, more uncertainty than we've had for a while, and whenever we hit these sorts of bumps in the road, investors always want to know, how are you reacting?
Well, that's a great question, Ward. I appreciate that. And you're right, there is increased uncertainty out there. The headlines are coming across the tape fast and furious, and investors are trying to figure out what to do with this information. We are not going to react. It's important right now to think about what a reaction is, and that's based off of emotion, and it's immediate. Our investment process has been built around removing that emotion, but what we are doing is we are approaching today's environment looking for opportunities that we might be able to take advantage of over the long term. Our investment horizon is 3 to 5 years or even longer, so we are always on the lookout for those opportunities, and as they arise, we're prepared to take advantage of them.
That's great. So one of the things that typically happens when uncertainty jumps up like it has right now is, regardless of what's going on with the particular company, investors instead flood into these more traditionally defensive areas in the world you operate in, the large cap value space and dividend oriented. There's a lot of those types of defensive companies like consumer staples, like utilities, and investors figure, even when we don't know exactly what's to come, you're still going to go buy toothpaste, you're still going to pay your electric bill. How are you thinking about things like that in regards to your portfolio?
That's a great point, and right now those types of stocks, we're seeing it in the price action of the stocks. Investors are looking for safety. We do own a couple of those in our portfolio. A name that comes to mind is like PepsiCo, so certainly a nice compounding consumer staple company. However, when we look out over the next several years, right now when you're talking about a name like Coca-Cola or Procter & Gamble, you're paying about 24 times earnings for minimal earnings growth over the next few years. We're talking 3 to 5% growth. That's just not attractive to us in our lens of long-term shareholder value. So we're not adding to exposure to those types of names. However, there has been some dislocation in the stock market. There are some areas that would traditionally be defensive, that would be stocks like Booz Allen Hamilton that we currently own. There's little economic sensitivity to Booz Allen Hamilton, as they are one of the largest government contractors. Their focus is artificial intelligence, cyber warfare, and really the modernization of IT. All of this aligns with the current administration's policies and goals, and it also aligns with the geopolitical environment we're in. However, the fear of Doge has resulted in a stock that has declined 40% since November. So I get it. There is uncertainty and there is fear, and we see it in the stock price. Booz Allen Hamilton traded at 28 times earnings in November. It's trading at 14 times earnings today. It has a growth rate. When I mentioned Coke and Procter & Gamble growing earnings at 4 to 5%, Booz Allen Hamilton is growing earnings at 3 times that rate. So those are the types of investments and opportunities that we're looking for and evaluating. And in this case, we already own Booz Allen Hamilton. Oftentimes, many of the best investments are already in your portfolio, but we are evaluating that name in particular and others that we own, just asking ourselves, is there a scenario where this is presenting us a unique opportunity to potentially increase that exposure?
That's great. So one of the things I think is reasonable to expect when you have what's the impact of tariffs are going to be, or trade policy is going to be, or reductions in spending is going to be, is if you're a business owner, you might delay some of the decisions you typically have in terms of your typical ordering patterns or hiring patterns or some of those things, where it creates a bit of a bump in economic growth. When you're looking out the next couple months and the potential for economic growth to look different than it has for the last couple years, how do you build that into what you're thinking about now?
What you're asking is spot on. Right now, there is a growing concern on economic growth as we move forward, and those concerns are valid. I would expect companies to pause some long-term investments right now. I would also expect consumers to potentially pull back a little bit. Uncertainty creates that. However, what the questions we're asking ourselves as an investment team, are there scenarios where when we're looking out over the next 3 to 6 months or longer, are there scenarios where we're talking about potentially peace in Ukraine? Is there a scenario where all of a sudden tariffs are dropped on our trading partners? And then we're looking at discussions that completely are different then than what we're having now. So as we evaluate those opportunities, we're taking into consideration, as dark and bleak as it may feel right now, there are plenty of scenarios where when we're looking out 3 to 6 months, where the discussions are much more optimistic, and we want to make sure we're positioned to take advantage of that.
That's great. Thanks very much. Thanks a lot for watching.